Debt keeps piling up. It's a real burden. But is it just you? What type of debt is most affected by the coming collapse? You need to know the truth. And that's why you came here for the truth. So let me unveil that for you. Let's talk about debt. You may see these businesses in the area that you live in. Money Mart, payday loan, cash advance. Essentially, people cannot go to a traditional lender, like a bank, to get money out. So what do? Well, they have to go to a loan shark. And that's essentially what these businesses are. They charge extremely high interest rates, and people pay because they need the money. So we'll get into some of the causes of this today, and we're going to talk about debt and how it is a real burden on the people. Look at this here. Credit card debt, okay? They call it total revolving credit owned and securitized. But essentially what we're looking at is credit card debt. And over the years, there has been an astronomical rise in the amount of debt that people have added onto their credit cards. We are well over $1 trillion worth. People started deleveraging and claiming bankruptcy during the financial crisis and what followed. However, we've gone into new records. Look, when you think about the Federal Reserve, the central bank of the US, they have been slowly but surely increasing interest rates. This, of course, puts a burden on any type of instrument that uses variable interest, or when it has to be refinanced years later. When you're talking big ticket items, maybe it's a car or anything, because people are basically financing everything these days. Remember that if you haven't secured that financing for the duration of the time you need to pay it, then you are going to be in big trouble. People are pushed to the edge. That I can assure you. All right, personal interest payments and total revolving credit. So we're looking at basic credit card debt, and you cannot deny what has happened here. There is no way, absolutely no way, that this could ever be turned around. People are paying more and more and more. They are carrying over a balance month after month. And essentially what we are seeing is people who will be permanently indebted. Okay, let's move on quickly. Personal interest payments, you can see that on its own right here. Talking about hundreds of billions of dollars. The financial crisis didn't fix anything. We've broken into new territory. Real disposable personal income, as well as credit card debt here. So the blue line is credit card debt. You could see how it is basically has moved over the past few years. And you have to look at real disposable personal income. On average, declining year after year. People don't have money. People only have credit. So in this period of time, we have seen this death cross action that has taken place. People don't have real money. They only have credit. Personal savings rate. This is a very, very good depiction of what I'm trying to talk about here. Since the 90s, you can see people save less and less and less. There's no way to deny this. Just looking at the statistics, you will realize it. And why? Because when you look at the average savings account out there, you're lucky. You are lucky if you get 1%. 1%. So why would somebody want to save when they're only going to get a 1% return, when they can take that and they can buy something with it? Well, that's the way people see it. If that same account was giving 10%, maybe they would choose to save. But that's not the case. Doesn't seem to be the case anytime soon. If anything, we're going to continue to drop over a longer period of time, of course. Now, the economy is weakening despite what you've been told. This is all part of the interest rate hike. Now, interest rates are going to affect credit cards, mortgages, and any type of loan that you have, your line of credits and everything else. So you need to understand why this is important. The economy is weakening, and the Fed, fearing inflation, is hiking right into it. Pending home sales, they unexpectedly dive to the lowest level in 3.5 years. GDP forecast dive. The GDP now forecast dips to 1.6%. Durable goods dive 3.7%. New home sales are down 7.8%, and so on. Okay, moving on. Look over into Europe, and you have a very, very big problem. They can't even get inflation to be where they need it to be at because they always want to create inflation. ECB policymakers are likely to discuss a small tweak in their communication stance at their March 8 meeting, but no major policy shift is expected, 3 sources said. All right? So essentially, the market is very weak. There's no way they can ever pull out of their QE. And essentially, they talked about not being able to do what they said. Concerned about recent market turbulence, the strong euro, and a dip in both headline and underlying inflation, officials prefer waiting, perhaps as late as the summer, before starting to signal the end of asset buys. So again, we have central banks needing to be there because the economy is so weak, so tired, so worn out that the central banks need to be there to print money to fill in the void. If you don't know this already, maybe you're not a regular viewer of this channel, Japan buys 75%. They own 75% plus of their ETFs, exchange traded funds. 75%. The real market is gone. It's only a central bank. So surely the statistics that you see could be good, but that's all with printed up money out of thin air. It's monopoly money. So no matter where you look around the world, there's different degrees of these conditions. But I would like to say that it's all heading downhill. That's just a matter of fact. So, what can you do to protect yourself? Number one, you need to get out of debt. Now, how can you get out of debt? I have a video on my How To and Solutions. I have a few actually that you can check out. How To and Solutions playlist. And I basically talk about making money on the side. You can do the gigs, different types of websites that exist out there that are able to make a little bit of cash on the side here and there. And you need to find a way to consolidate all of your debt into the lowest possible interest payment. All right. So if you have, 10 different credit cards and you have all these different places that you've been and accumulated debt, you need to find a way to consolidate it all, put it onto the lowest possible interest payment thing that you can find. So let's say like a line of credit at your bank, if they'll give it to you, you need to get that on there and then you could pay that off. That will save you so much money. That's a very simple explanation. At the same time, you want to be making more money. That means ultimately using the skills that you have today, or using your time, or using your energy to be able to convert that into currency, pay down the debt, get out of debt. Once you're out of debt, then it's up to you where you want to go from there. But that is something that is very important. And a lot of people don't really want to ever get out of debt. And it's a very, very vicious spiral. I talk to a lot of people who are heavily in debt. And unfortunately, they seem like they're broken and that they can't turn it around. But I assure you, you can. You can do it. If you found this video informative, please give me a thumbs up. If you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books at Amazon. There are links in the description below which will allow you to flip through these books for yourself. Take care.